그리고 바로 네 번째 세션으로 넘어가 보도록 하겠습니다. 네 번째 세션에서는 환경 분야에 저희가 초점을 맞춰서 기후변화 그리고 탄소 배출에 대해서 논의를 해보려고 합니다. 오늘 발표를 해주실 메리 렁 CFA는 애널리스트와 그리고 펀드 매니저를 비롯해서 20년이 넘는 금융권 경력을 갖고 계시고 현재는 아태 지역 CFA 인스티튜트의 헤드를 역임하고 계십니다. 오늘은 Climate Change Analysis in the Investment Process, 투자 과정에서의 기후 변화 분석을 주제로 말씀해 주시겠습니다. Mary, over to you.
Good afternoon, everyone. I hope you can see my screen. Very, very happy to be here today and share my presentation on climate change with you. I would like to start by thanking the Korea Society and COFIA for this opportunity. So here's what we're going to cover today. Today I have the pleasure of sharing some of the insights from an award-winning CFA Institute report that was published late last year on the integration of climate change in the investment process. And then we're going to take a quick look at the key sustainability reporting frameworks for issuers. As investors, it's important for us to understand what some of these reporting frameworks are about, because we'll be relying on the information coming from issuers to evaluate and assess some of our investment opportunities. And then we're going to look at some of the global regulatory policies around the world, which are driving many of the changes in this area that we're looking at. So climate change presents a significant challenge to global markets and economies. And the issue is going to pose additional costs and risks to all parts of society. No one can escape. And finance has a key role to play. And that was the driver for CFA Institute to start this project. In particular, we wanted to focus on the role finance can play in allocating capital more effectively and efficiently to mitigate climate change. So on the right-hand side, you can see the cover of our report. It's called Climate Change Analysis in the Investment Process. We aim to provide knowledge and improve understanding on how climate risks can be applied to financial analysis and portfolio management. And through this study and through sessions like this, we hope to be informing practitioners some of the considerations and key drivers for incorporating climate change, what are the best practices out there, and what are some of the resources that are available to investors. So the report is available for free on the CFA website, so please feel free to scan the QR code and check it out. So how does climate change come about? Well, actually, it's basic physics. Greenhouse gases trap heat in the atmosphere. The more greenhouse gases we put into the atmosphere, the more heat they trap. And since the Industrial Revolution, humanity has been pouring vast amounts of greenhouse gases into the atmosphere. And up to a point, our trees and oceans were able to absorb these gases, but no longer. Evidence suggests that we are now past that point. And the increase in atmospheric temperature is contributing to a host of problems. They may be droughts, famines, bushfires, extreme weather events. And that in turn will lead to more property damage and dislocation of communities than any of us have seen in our lifetimes. We don't know when these changes will occur, but we're confident that they will. And climate change is going to have an impact on every company and every investor on this planet. And that is a compelling reason why investment professionals need to incorporate these new realities into our analysis. So that when we are making an investment decision, we have the necessary information to be making those decisions in a world where the effects of climate change are increasing. Now, what are some of the typical climate change risks? They are largely in two buckets: physical risks and transition risks. Let's take a look at physical risks. Many of us have already suffered from or heard about the increase in extreme weather events associated with climate change: typhoons, hurricanes, floods, fires. And these physical changes to our environment will affect every company to a degree. And as investors, we need to be able to identify and evaluate the impact of physical risks associated with climate change. What about transition risks? Well, the world economy will change to a much less carbon-intensive economy over time. But the question remains, how fast will this happen? At what speed will this happen? How will these transitions be funded? And most importantly, who will be the winners and losers? And investors will need to educate themselves on the transition plans of major economies around the world. And what that means for the sectors or the companies that they are investing in. So for example, according to one estimate, electric cars will make up 50% of the global vehicle fleet by 2035. Okay, so by 2035, half of all cars will be electric cars. If that estimate is correct, there will be massive disruption, not just in the auto sector, but also in oil and gas and energy production industries. Which side of the risk do you want to be on? Now, all industries will undergo some transition to a lower carbon world, some fast, some slow. And it depends on government policies, consumer preferences, and the companies themselves. Now, and this is the opportunity for savvy investors, right? Because of this transition, there can be huge opportunities for those who are savvy enough to identify them. The most effective tool in combating climate change is the price on carbon. By putting a price on carbon emissions, we can use the invisible hand of the market to create an incentive and move economies away from burning fossil fuels. Currently, there are two main methods for pricing carbon. The first is a carbon tax, and the other is a cap and trade system. Let's start with the cap and trade system. It basically sets a carbon budget for a market, and permits or credits to emit or to pollute are sold to users. So companies must buy permits in order to emit, say, for example, carbon dioxide or whatever emissions that they are that's covered above the level established by the cap. So, and these permits can be traded on the secondary market. So over time, if companies want to save costs, they are incentivized to lower their own emissions. So that's the cap and trade system. Under carbon tax, a fee is placed on carbon generating activities so that both industries and consumers are incentivized to substitute cleaner energy solutions for fossil fuels. As an example, consumers who have cars and they wanted to go and fill up their petrol tanks, over time they'll feel that they're paying more to fill up their petrol tanks, and they want to move, and that will motivate them to move to hybrid or electric vehicles. But as with any taxes, finding the right level is key. You don't want the tax to be regressive. If you set the tax level too high, then it will hurt economic activity. But if you set it too low, it will not bring about the desired behavioral change that we want. Now, a price on carbon is a great market-based solution, but it's not this magic silver bullet to solve climate change. It's a key step, but it's not, that alone is not going to solve everything. So as part of our report, we actually did a survey of our CFA membership last year to understand where the industry was when it came to climate risk integration. And globally, we had just under 3,000 responses. So on a very high level, we asked if respondents thought that it is important to have a view on climate change to effectively manage investments today. And 76% of all global respondents said it is either important or very important, 76%. And then we asked them whether they were currently incorporating climate risks into their portfolios. And that's the chart on the left. Globally, 40% said yes, they were incorporating climate risks into their analysis, and 60% said no. But when we break out the data into the three regions of Asia Pacific, Americas, and Europe, Middle East, and Africa, APAC, which is the purplish blue bar third from the left, had the highest percentage said no. So 67% of APAC respondents said no, they are not incorporating climate risk versus the global average of 60%. Another question that we asked was whether respondents saw much demand for portfolios that would lead to lower carbon intensity, and that's the chart on the right. Globally, about 2/3 said no, they're not facing much client demand. And again, the demand is lowest in Asia Pacific. What can we infer from this? Well, one view could be that our clients in APAC have minimal requirements in climate change solutions. So no change is required to how we go about our business in terms of portfolio management or securities analysis. I hope this is not the conclusion you're drawing. Rather, and this is my personal view, managers elsewhere are building up their suite of solutions, their capabilities, and track records. And we all know how savvy clients in Asia Pacific are. So my inference would be that the industry cannot afford to wait. They need to be leading their clients. We should all be leading our clients and developing the right solutions and expertise in order to position ourselves for this change. So if we're not waiting and want to be proactive, what can an investment professional do to position themselves, right? So here's our suggestions. Well, we need to get up to speed with the market and economic implications of climate change and how that would impact our investments. So thank you for having me. I hope this fulfills part of that journey. We need to start factoring in carbon prices into our financial analysis. We need to get a better understanding of the expected intensity or frequency of physical and transition risks. And we also want to familiarize ourselves with the standards which are increasingly framing the conversation around climate-related risks and disclosures. And I'll go into that in the next section. And engagement is key, and there are two levels of engagement. At one level is on the availability of information. Let our voices be heard as investors. We need to let regulators and companies know what climate-related information we find most useful. So that's one level. At another level is the stewardship perspective. We need to be engaging with companies that we invest in to understand what strategic steps they are taking to mitigate this risk. So we're not helpless. There's much that can be done. Finally, in this section, I just want to say that in the report, a number of asset managers worldwide have contributed case studies, and they cover a wide range of topics, geographies, asset classes, from developed markets to developing markets, from equities to fixed income to carbon. There are some general case studies, some very macro, and some sector or theme specific. So please check it out. And now I'm going to move on to global reporting frameworks. So data availability has been a key constraint when it comes to climate and ESG. Data has gotten a lot better, but challenges still remain. And there's still a huge amount of expectations on issuers to be providing timely, consistent, relevant, and decision-useful information. And hence the importance of understanding issuer disclosure frameworks. One problem is that there are quite a few of them, right? And actually, no, that's an understatement. There are many of them. And it's confusing, not just to investors, but also to issuers themselves. And if we were to go through all of them, we'll still be here after a 3-day marathon session. So today, I'm going to stay and focus on two, SASB and Tcfd. And I know that previous speakers have mentioned those. So here we go. SASB stands for the Sustainability Accounting Standards Board, and they focus exclusively on the materiality of ESG information, including climate-related data. It's a great research tool for investors because of their focus on materiality, and they help investors filter out the noise or the data that are not material or relevant. So this chart shows the SASB materiality map for 10 different industries. The industries are shown across the top, ranging from consumption, healthcare, renewable energy, services, transportation. And down the left-hand column, we have a list of issues. They are environmental issues, social and human capital. And on the next slide, I have business model and leadership and governance. And then in the middle, that's the heat map. The heat map shows how material these issues are for companies in different industries. So the red box are issues that are likely to be material for over 50% of that industry. Orange box, less than 50% likelihood. White box, not likely to be material. So let's take the first issue under environmental, which is greenhouse gas emissions. It is red for non-renewable resources and transportation. So i.e. for those two sectors, greenhouse gas emissions are very likely to be material. And they're white for financials and healthcare example. So makes sense, right? So the SASB framework focuses on what's generally agreed upon to be material in a given industry. And that's a great starting point. Now, you can always go beyond the SASB recommendations if you believe there are more material factors. And then next, I'm going to talk a little bit about the Task Force on Climate Disclosure, TCFD. They have recommended that companies disclose climate-related information in 4 key areas: governance, strategy, risk management, metrics, and targets. And I'm not going to go through the detail. But the objective here is so investors can be better informed about the climate-related risks and opportunities for companies in their portfolios. So why is this important? Many governments and regulators are adopting TCFD or making reference to TCFD as a policy direction. So for example, the UK, United Kingdom, they have made TCFD mandatory for large companies and financial institutions by 2025. And some governments, such as Canada, have decided to make COVID-19 bailout packages conditional on adopting the TCFD recommendations. Closer to home, in Hong Kong, the finance industry, banks, insurance companies, asset managers have to provide mandatory TCFD disclosures by 2025. And Japan has the world's largest consortium of TCFD members in the world. So a lot of focus is now on TCFD. And then lastly, I'm going to look at regulations around the world. Now, we've all been in lockdowns. We haven't been able to travel for a long time. So let's take a virtual global tour and look at what regulators are doing around the world and how it affects us in Asia Pacific. So there are many initiatives across the entire finance ecosystem. This chart shows investors at the one end and companies at the other. And kind of the investment managers sit in the middle and facilitate and direct capital flow from investors to companies. And because of this, because of the concern over greenwashing, there have been increasing number of policy tools and guidances around the world on sustainable finance. And according to Principles of Responsible Investment, or PRI, there are over 650 policy tools and guidances around the world on sustainable finance. Many deal with issuer reporting, and that's the top right-hand corner. And we've covered SASB, we've covered TCFD, but there's GRI, there's CDP, and there's lots of other acronyms. Other policies and guidance deal with green and sustainable instruments that are issued by companies or governments, such as green bonds. So that's kind of the bottom left-hand corner, under stocks and bonds. So we have green bond principles that are issued by ICMA. That's the Climate Bonds Initiative. So that's another group. So asset managers are also increasingly asked to improve their disclosures to investors. So both, and this increase in disclosures are both on their approach and on the process in managing climate or ESG risks, as well as on reporting outcomes of their stewardship activities. So going forward, I think there will be more attention on disclosures at the investment product level. And by investment products, I mean funds that are being manufactured by asset managers. Investment product regulation or disclosures have been relatively less developed compared with issuer disclosures, because you kind of need issuer disclosures first before product disclosures can be reliable, because you're putting all these securities into your fund, and if the companies are not providing the right disclosures, the asset manager cannot do that for their fund. Now, I don't have a crystal ball, but I think it's safe to say that there will only be more regulations in the sustainability area. And in 2020 alone, the PRI has identified 124 new or revised policy instruments. And that's the highest annual number so far, and 32 more than 2019. And for our virtual global tour, we're going to start with the EU, because they have the most spectacular, revolutionary, eye-catching, jaw-dropping changes, okay? The EU is implementing a range of initiatives to meet its environmental commitments, ranging from its action plan on sustainable finance to the EU Green Deal. And basically, for the EU, sustainability is a top-down policy effort, and they want to make sure that EU can reach its goal of reaching net zero emissions by 2050. So everything, is centered around that. And that's why I say this is a very simplified view. So what are some of the key pieces of ESG regulation that's coming out of the EU? So today I'm going to focus on the three that's on the slide: the taxonomy regulation, the non-financial reporting directive, NFRD, and the sustainable finance disclosure regulation, SFDR. They are the most relevant and most impactful to the finance industry, and they're all interlinked. So the taxonomy regulation establishes an EU-wide classification or framework that will define what economic activities are considered environmentally sustainable. And you can think about it like a catalog or the ultimate Bible. So if an activity is in there and it's classified as sustainable, then you're in business. Okay, so that's kind of the overhanging kind of library of Bible of activities that are considered sustainable. So that's taxonomy. NFRD requires companies to disclose non-financial information in relation to how they manage social and environmental changes. And that means companies are required to disclose information on the proportion of their activities that are classified as sustainable based on the taxonomy, okay? And then you can calculate the percentage of turnover a company has that is sustainable. So that's NFRD. And then you have finally the SFDR, which is the most relevant piece of legislation for asset managers. It's directed at everyone in the finance industry, financial services industry, whether you are a product manufacturer or financial advisor. And the ultimate objective is to raise transparency and combat greenwashing. And the most visible changes of SFDR, which came about in March this year, was that all financial institutions selling investment products in the EU must now classify their products into 3 categories. If you are an Article 9 product, you are dark green. If you are an Article 8 product, it's light green. Or if a product is Article 6, it's gray. And as the name implies, Article 9 products must meet a higher threshold of sustainability, with all their holdings meeting the definition of sustainable investment. So in terms of disclosures, asset managers are required to publish information on their website. It includes pre-contractual disclosures, and you have to tell your investors about the policies and processes of the integration of sustainability risks. So as you can see, they're all interlinked because you need the taxonomy to define the economic activities. You then need the companies to tell you to disclose whether their activities fit with the taxonomy. And then the SFDR, the asset managers, will collect this data from companies and analyze it and make sure that, and then classify its products accordingly. Now, you may think, well, the EU is far away. Why does it matter to me? Well, even if you're not in the EU, this may impact you. This may impact you in several ways, some more immediate. If you're marketing your funds into the EU and if your funds are registered under AIFMD, then you may be caught. Or if you're providing portfolio management or investment advisory services to EU firms, you may be caught. And even if you're not doing any business with the EU, they are by far the most advanced in terms of ESG regulation. And many regulators are monitoring developments there and deciding if they want to follow. Okay, 2 more slides. All the time I spent in the US, I can save all the time I save I had speaking on the EU, I can save on this slide because there's not much going on in the US, but it's changing. Okay, so in the past, the SEC has declined to put any regulation out there about disclosures or to mandate issuer disclosures, but that's changing. There's a new administration and there are clear signals that they're going to focus on climate risk and ESG. they're already talking about stepping up in examinations of fund managers who claims to provide ESG services and products. They have set up a task force to look at climate risk. They are going to review corporate disclosures about climate risk. Will it happen in a big way in terms of a new regulation? We don't know, because it's not without challenges. So some people in the US are already challenging the SEC about mandating issuer disclosures on non-financial information. So it remains to be seen. And lastly, I just want to say that at the CFA Institute, we are also developing a disclosure standard for investment products in the ESG arena. And you may think, oh, why do we need another standard, right? But this one is different. So we're in the process of developing a global voluntary disclosure standard for investment products. We hope that with this standard, can raise transparency and allow investors to better understand and compare investment products. So we are going to issue an exposure draft of our standard next month, and I hope to have the opportunity to come back and introduce that to you. And with that, I'm going to finish my presentation. Thank you.
Thank you very much, Mary. We have a question from the audience. Could you, you mentioned the carbon market, so could you elaborate more on the carbon price into the financial analysis? So how can we apply? So could you introduce some specific methodology or examples? Yeah, so some of the scenario, some of the case studies that we've seen is that maybe currently, analysts love discounted cash flow models, right? So in your cash flow, in your DCF model, you may be forecasting costs going a certain way, okay, without a carbon market. But let's say a country is trying to introduce a carbon tax or carbon price, then its costs will change. So as one of the ways that you can incorporate that in your analysis is to build a scenario to say what happens to this company's cost base if carbon price is, I don't know, $50 a ton, and what if it goes up to $100 per ton, right? What is it going to happen to its margins? Will it cease to be competitive? And it would be even more interesting if you have two companies in the same sector, in the same country, and you already know that they're taking vastly different approaches to how they address that, right? So even though there may not be an active carbon price in that market, some companies may be more proactive or maybe have more, forward-looking and decided that they are going to de-risk themselves in terms of carbon price and switch their energy sources to renewable sources, for example, right? So if you have two companies and you can see that on a comparative basis, one is doing more to get ready for this transition, then you may also, you may think that you may overweight that company versus the one that's not ready. So these are some of the ways that analysts can do in terms of taking into account the carbon price into their analysis. Okay, so due to the time constraint, I will ask one last question. Okay. Then according to your slide, the climate survey results show that in the Asia Pacific region, only 33% respond that they incorporate the climate risk into their portfolio analysis. Yeah. Then what are the main barriers and drivers to ESG engagement in the Asia Pacific region?
That is a very, very good question, because it is a question that we asked our respondents. So one of the questions we asked is, why don't you or your organization incorporate climate risk into your analysis? And the single most selected answer globally and in APAC was the lack of measurement tools. Okay, so that's one key driver. The second most selected answer globally is that there's no client demand. Okay, in Asia Pacific, the number 2 and 3 are the same, and the reasons were there's not enough client demand, and it's not required by regulation. I think the last answer is a bit dangerous, because I don't think that we should wait until the regulators tell us to do something. We want this to be a market-based solution, because when the regulators tell us to do something, it becomes, it is probably not as effective as it should be. But anyway, so those were the key drivers in APAC: lack of measurement tools, not required by regulation, and no client demand.
Thank you very much. So due to the time constraint, now let me close this session. So thank you again for your presentation, Mary. 네, 이상으로 네 세션을 모두 마무리하도록 하겠습니다. 미처 저희가 답변 드리지 못한 질문들은 추후에 이메일로 답변 드리도록 하겠습니다. 그럼 웨비너의 마무리는 이제 유정선 과장님께 다시 넘기도록 하겠습니다. 감사합니다.
감사합니다, 교수님. 금일 ESG 심포지엄 웨비너 발표자분들과 공동 주최해주신 CFA 한국협회에도 감사의 말씀드립니다. 부디 오늘 웨비너가 참석자분들의 ESG 업무에 큰 도움이 되길 바랍니다. 오늘 저희가 답을 못 드린 질문이 있거나 추가 질문이 있다면 seminar@pia.or.kr로 부탁드립니다. 발표 자료는 참석하신 분들께 메일로 발송해 드리도록 하겠습니다. 함께 해주셔서 감사합니다. 안녕히 가십시오.